President Trump's tariffs have sent the markets into a downturn, and many investors are rightfully worried. But before making any big moves, there is a strategy that could help you ride out the storm and even come out stronger on the other side. Instead of reacting, you should use this simple yet powerful approach to investing, which offers diversification, stability, and long-term growth. In this video, I'll break down exactly how investors should take advantage of this approach, especially with the uncertainty surrounding the so-called Trump downturn. Hey everybody, my name is Darren, and a few years ago at the age of 50, I realized that the stock market wasn't so scary as I thought. So I jumped in, started investing, and decided to document every step along the way. My goal with this channel is very simple: to share my progress with you. My first big goal was to take my TFSA from zero to maxing it out, and I can happily say that I'm over halfway there. Nearly 100 videos later, I've shared the lessons that I've learned, the mistakes that I've made, and the strategies that have worked. Hey, if I can do this, so can you guys. All right, we're gonna jump right over to my portfolio and see what this so-called Trump downturn has actually done to my portfolio. Okay, so I'm filming this on March the 20th. Now, if you've been following me for a while and you're looking for my updates where I do basically every time I make a purchase every 2 weeks, I usually update my portfolio for you guys. But I've been really busy at home and I haven't been able to make any videos until today. And rather than going back and showing you what it was, because I did make purchases which were 2 weeks ago and then just the other day, I'm just going to show you how the portfolio is performing with the tariffs in place. If you look at my last monthly update, you can see how far the entire portfolio has fallen. But for the main videos that I shoot, which is where I show you my main Wealthsimple account, and that consists of my cash account, my TFSA, my RRSP, and the kids' RESP. Of course, in that video, I'm showing you me building my TFSA from zero to maxing it out, as I said in my intro. And it's that account that I'm trying to grow and max out. So we can see here that over the last month, my account is down 3,772. So that's all 4 of those accounts. So let's jump down and we'll look at actually the TFSA because it's kind of the star of the show, and we'll go over things. So the account's sitting at $53,889. Now, I did make an investment into my TFSA, but it's not in this particular brokerage right now. Stay tuned for more on that. So over the last day, this account's down $202. Over the last week, it's up $955. Over the last month, it's down $1,915. Now that is the biggest drawdown I've seen in this account. And over the last 3 months, it's up $66.19. Year to date, up $419. And over the last year, up $4,810. And all-time returns $7,235. It looks like there's 36 bucks in there waiting to be invested. And here's a quick overview of all of the positions within my account. And of course, most of my updates, when we look in there, we're looking at things that are green because things are growing. And of course, with the tariffs, every time Trump opens his mouth, things change, and we can see a lot of red going on in that account. If we look at my RRSP, it's pretty much the same picture, down $25 on the day. Over the week, up $480. On the month, down $857. Over the last 3 months, down $380. Year to date, down $347. Over the last year, up $2,280. And all-time returns up $3,834. And if we look at the kids' RESP, it's sitting at $80,788, and it's steadily growing. Now, for those of you who are new to the channel, I have 2 kids. This RESP is a managed account because Wealthsimple does not offer a DIY version, and I make regular contributions into it looking to max this out. Of course, for each child, you can put 50,000 into it. If you're looking to learn a little bit more about RESPs, I have a few videos in my library that will help you out if you have kids and you want to learn more about them. Recent policies and statements from President Trump have sparked significant market reactions. Let's face it, every time he opens his mouth, the markets take a dumper. For instance, aggressive tariffs on major trading partners like Canada, China, and Mexico led to increased uncertainty for businesses and investors. And let's face it, the stock market doesn't like uncertainty. Let's face it, this trade war is sending the markets into a tailspin, and no one really knows when it will end. What's worse is this could have a major financial impact on your portfolio. Now, what exactly are tariffs? Well, basically they are taxes that government imposes on goods that are imported into the country. They're used to regulate trade, protect domestic industries, and generate government revenue. So in this case, Trump's using these tariffs to deter companies from importing goods into the United States. Now, let's use a real-world example. Let's say you have a car company in the United States that want to manufacture parts. They use a Canadian company to manufacture the parts and then import them over the border to finish the car. Let's say that car part costs about $100. When you introduce a 25% tariff on that, that car part all of a sudden becomes $125. Now, the company is going to pay this at the border to get it over, but eventually they will pass that on to the consumer. Now, this eats into their profit margins, and eventually this company will likely have to look at opening a company in the United States to manufacture these parts in order to increase their bottom dollar. Now, let's say you own shares in the company in Canada that made the part. Well, obviously you're going to see a significant decrease in your share price, or worse, the company might actually go out of business and you're left holding the bag. But hey man, don't panic, because there actually is a solution to this. Now, tariffs are actually nothing new, but the intended use of them has changed over time. Now let's look back to 1790. At that time, the American government used tariffs in order to generate 95% of the revenue for the government, because at that time there was no such thing as income tax. Fast forward to 1860 and nearly everything is still being tariffed, but now the US government is using the tariffs in order to protect the economy within the United States and the jobs that exist within the country. Now fast forward to 1913, and this is when the US federal government actually introduces the income tax system that they currently use today. Fast forward to 1934, and the US is in the grips of the Great Depression. This included the 1929 Black Tuesday stock market crash. The government obviously needs to find ways to get the economy going again, so rather than using tariffs, they actually reduced the tariffs, opening up the borders to trade around the world and to the global markets in order to stimulate the economy. Now let's look at my portfolio again. If we use Blossom Social, which by the way folks is a great place for investors to learn about investing, share investing strategies and ideas, as well as their portfolio. And in the current political climate, if you're looking to use Canadian companies, this app was actually created by a bunch of Canadians. So you'll be supporting a Canadian product. We can see here that my portfolio in the last month is down about 6%, and in the last 3 months it's down about 3.25%. Of course, this in itself doesn't really mean much, so let's compare that against the S&P 500, which in the same period of time is down 4.04%. Now, if we look at this in terms of real dollars, you may find yourself feeling a little nauseated, because over the last month, the 6% downturn equates to about $20,000 in my portfolio, which is about a $330,000 portfolio. Now, imagine what this would be like if your portfolio was worth a lot more. So if you're not willing to stomach these kinds of downturns, you might want to employ the strategy that I'm looking at. But let's face it, we're using a micro or very small lens, looking at a very small period of time in my portfolio. And let's face it, the stock market's been around for a really long time. In fact, the New York Stock Exchange was actually created in 1792. Now we know that, of course, that the market can't always be going up. It definitely has its ups and downs. In fact, stock market corrections are actually fairly common, with the S&P 500 itself logging at least 56 times since 1929 a stock market correction, according to Reuters' analysis of their own data. A stock market correction is actually defined by a decline of about 10% or more, and lasting on average about 115 days according to the same research. Of those, only 22 morphed into a bear market. Now, what's a bear market? A bear market is defined as a fall of 20% or more and can last on average at least 10 months in time. So on the surface, this downturn right now makes it look like maybe we should jump off and get out ASAP. But let's pull out a bit and look at my portfolio using passive. While I'm new to investing, I have seen this before. We can see this back in October of 2024, my portfolio took a significant nosedive and eventually corrected itself afterwards. I didn't panic, nor did I sell anything. In fact, I actually kept buying. Now, what we really don't want to see is another stock market crash like the one in 1929. Stock market crashes are actually very infrequent, but can also be very devastating to investors. The long and short is we have no idea what will actually happen in the market tomorrow, but we want to be prepared. Now, based on the tariffs, certain sectors and companies are likely to be negatively impacted, while others could actually come out on the positive side of this. A lot of investors panic sell during market downturns, but that's often the worst thing that you can do. Instead of selling out of fear, here are 3 key questions to ask yourself before making any moves whatsoever. Number 1, has anything fundamentally changed? If you own strong companies with long-term growth potential, there's absolutely no reason to sell. Number 2, do you need the money soon? If you don't need your investments in the next few years, holding through the volatility is often the best choice. And number 3, are you rebalancing? If one part of your portfolio is overweighted, it may make sense to shift funds, but this should be a strategic decision, not one done during an emotional time. Now, here are my top 4 things that I would do with a portfolio in 2025. Number 1 is we want to create a diversified portfolio. So let's say you're all in on technology such as Apple or Tesla. Well, those positions right now are going to take an absolute beating, dragging your portfolio down. You may want to spread this out and look for sectors and companies that could weather the tariff storm. This could be things such as steel or aluminum or defense companies. So when Apple goes down, your other positions may go up, having less of an impact on your portfolio. Number 2, consider your time horizon. Right now we're zoomed in on such a small portion of the tariffs. But let's take a step back. In my case, I have about 10 or 15 more years to go, maybe even 20. You might have 20, 30, or even 40 years to go. And all of these corrections will eventually work themselves out over time. Number 3, dollar cost averaging. The average investor can't beat the stock market. You want to set yourself up with the asset allocation, stick to your plan, and have money set aside. In my case, every 2 weeks I get paid and I set money aside and I invest that into the stock market. So when the stock market's up, it may average down, and when it's down, it is going to average up for me, ultimately creating gains in my portfolio. Number 4, focusing on companies that have a solid foundation and can stand the test of time. Picking penny stocks or trying to pick the next Apple can be equated to gambling, and this could cost you a lot of money and not grow your net worth. Now, I'm sure all of this is sounding pretty interesting, but I did say that there was a strategy that you can use to weather these tough times, and it incorporates all of the strategies that I just mentioned and requires little to no effort. Of course, what am I talking about? ETFs, or exchange traded funds. They're one of the best ways to invest during a market downturn because they provide instant diversification. Instead of buying individual stocks, which can be risky, ETFs spread your investment across multiple companies, industries, or even asset classes. This reduces your exposure to any single stock market crash. Let's use an example. A Canadian investor will often hold things from the TSX or the Toronto Stock Exchange. One example of an ETF would be XIU. In this case, you own the top 60 companies within Canada, which reduces your risk from holding, say, 1 or 2 of those positions should they go down. Now, Canadian investors often focus too much on the TSX, but did you know that Canada makes up only 3% of actually the global stock market? That means if you're not investing internationally, you're missing out on 97% of global opportunities. Now, the Canadian stock market is dominated by just 3 sectors. That's financials, energies, and materials. While these sectors are strong, they don't provide exposure to some of the fastest growing industries in the world, like technology, healthcare, and consumer goods. By investing in international ETFs, you can access a broader range of industries, reduce your home country bias, and protect yourself if the Canadian economy slows down like it currently is right now. Alright, so exchange traded funds, or ETFs, offer a cost-effective way to achieve diversification. Now, we're going to use my portfolio to draw out a few of the ETFs that I use and show you what a balanced percentage portfolio might look like. Now, Canadian equities, like I said, are the smallest part of the global equity market, so I know 20 to 30% or even less might be important. And you could hold an ETF like XIC. With US equities, a little bit higher, 30 to 40% with VFV or ZSP. On the international equity side of things, about 20 to 30%. You might want to consider holding ETFs like XEF and XEC. This gives you exposure to developed and emerging markets around the world. You could have some fixed income. I don't have any of that right now, maybe sitting at 10 to 20% with bonds or ETFs. An example might be ZFL. And finally, 5 to 10% in things like gold or real estate trusts. And the ones that I hold are VRE and GLDM. But of course, you can adjust these percentages to how you like, and passive is a great tool to do that for you. All right, so we've established that ETFs are a great way to diversify your portfolio, spread out your risk, and allow your portfolio to grow over time with little to no effort. Now, if you're just starting out and you're not really sure how to get started, you should watch this video right here where I lay out a very simple portfolio.